Thank you, everyone, for joining us for today's panel. My name is Sue. I'm the principal at Circuit. Circuit is a decentralized market-making protocol and focused on providing liquidity for decentralized exchanges. And today, we're so honored to have three brilliant founders to be with us: Cindy Leow from Drift Labs, Jeff Yan from Hyperliquid, and Julian Ko from Ribbon Finance, now Avo. So we'll kick off with a brief introduction. We'll start with you, Cindy.
Hey, everyone. Glad to be here today. I'm the co-founder of Drift. We're the largest perpetual DEX on Solana, doing over $10 billion in cumulative volume to date. We are built using a hybrid AMM order book, which is fully on-chain and fully basically tailored to bring more people using centralized exchanges to the DEX experience.
Next, we have Jeff Yan from Hyperliquid.
Hey guys, great to be here. I'm Jeff. I lead engineering and product at Hyperliquid. Hyperliquid, we like to think of it as sort of the brand as like the people's DEX. So we try to bring the ethos of crypto to decentralized perps trading, so like community ownership, decentralization, etc. So maybe one popular product we have is HLP, which instead of DMMs and other market makers with special privileges, we let users come in and provide protocol liquidity, bootstrapping it, and it's been a pretty successful experiment with almost $1 million in P&L since 4 months ago when it launched, all to the users, and the fees also accrue to this vault. I guess similarly, we try to list all the interesting new coins that people want to trade, like Friendtech Index, other Rollbit, Unibot, other tokens where it's hard to find perps on other venues. So yeah, really trying to bring the spirit of community ownership without sacrificing centralized exchange experience and liquidity. So, yeah.
Thank you, Jeff. Next, we have Julian Ko from Ribbon Finance, now Avo.
Hi, my name is Julian. I'm the CEO and co-founder of Ribbon Finance, which has recently rebranded to Avo. For some context, Avo is a new DEX that's focused on options and perps. We do majority of the option volume on-chain, close to $20 million of open interest, and we've recently started expanding into new products such as perps and a few other strategies and a few other things. But yeah, excited to be here today to talk about DEXs, and hopefully I can bring like an options angle to it as well.
Thank you so much, Julian. So to kick off, since last year, we have seen DEXs gaining a lot of traction post the FTX events. However, despite the impressive growth, DEXs still account for less than 5% of the trading volume than SEXs. So for all the DEX founders here, my first question is, what do you think is the key issue that we need to address right now so that DEX can one day compete with the SEX volume? We'll kick off with maybe Julian.
Yeah, I mean, the number one reason why DEXs have not taken off is liquidity. I mean, it's basically impossible to find a DEX which has 10% as good liquidity as Binance, I would say, on majors and most pairs. So yeah, I think most power users and institutional traders will still choose to trade on the biggest centralized exchanges as long as liquidity is there. But I think, I mean, a lot of new DeFi projects are trying new ways to get liquidity, such as like the vaults and so on. And I think like post-FTX, I mean, 1 year ago, FTX hadn't happened yet, so this was like a very different conversation. But post-FTX, a lot of institutions are now sort of more wary of counterparty risk. I think a lot of people are somewhat fearful of Binance and a few other exchanges going down. So yeah, I think there has been like a recent shift towards DEXs in the last 6 months. But yeah, I mean, it's still really early. I think before we can actually beat some of the centralized exchanges, we need to improve liquidity by an order of magnitude. So every DEX is trying different ways to attract more liquidity.
Great. Cindy or Jeff, do you want to add on anything?
From our perspective, we think that liquidity comes hand in hand with taker flow as well. I think market makers, while post-FTX, have been more wary of going straight into DeFi and jumping into the deep end to provide liquidity. A lot have even retraced from trading on DeFi. I think it's clear that market makers will go where the takers and the retail are. So one thing that like begs the question of is why are retails not on DeFi yet? And I think the main question there is how can we make the experience better for an average retail to simply plug money into an exchange on DeFi as they do on centralized exchanges to trade like directly on the spot. I think right now, if you look at the average time needed to onboard into DeFi, it's pretty long, right? It could even take days if you can't get your money into crypto. So that deters most people from even coming in. So I think one of the reasons that crypto DeFi hasn't taken off as much as centralized exchanges is the like long onboarding times needed. And once we solve that and give retails a reason to trade, I think having unique assets that are untradeable on Binance is very important to actually push users towards this direction.
Sure, and I guess I'll add, I totally agree with the liquidity and the on-ramp, so I won't talk more about that. I think one last point is the actual UX of trading. So I think as a space, like DeFi has come a long way since even a few years ago where all the trading was through Uniswap and you needed to figure out the wallet thing and fidget with that like every time you wanted to do anything. Like if you wanted to place and cancel an order and you needed to like sign something each time and like 10% of the time it like bugs out, like that's just like not acceptable behavior for people who are used to the smooth centralized exchange experience. So I think a lot of progress has been made there. Ultimately, it'd be cool to see the wallet entirely abstracted away from a user. But even now, it's like way better than a year or two ago. Like you can, most platforms have like one-click trading at least. So maybe you onboard with your wallet, but then after that, you can basically like squint your eyes a bit, and it feels like a centralized exchange. So I think a lot of cool stuff coming there too.
Cool, that sounds really cool. Actually, on that point, so what do you think is actually something that DEXs do so much better than SEX? Of course, we run through the issue of liquidity, on-ramp, and UI UX, but anything that we can offer that they cannot?
The core thing that I think drives us as an organization and is the reason that we built a DEX in the first place is censorship resistance. I think the trend that we've been seeing post-FTX is centralized exchanges have started shutting off access to most users in like most regulations. And I think that trend is going to spike up to the point where it's going to be unusable. Like in Hong Kong, only high net worth individuals are actually able to trade perps on centralized exchanges. So I think the core feature of DEXs is really to be unruggable and ensure that reserves are always there, ensure that there is always a liquidity point for users to be able to access. So that omnipresence is something that's very important to us. So something that has an extremely strong foundation and is unable to be resistant on the censorship side.
Anything else from anyone to add?
Yeah, I think for us, transparency is sort of one of the big reasons why people would trust a DEX over a centralized exchange. I mean, like looking at the solvency of the exchange is almost as trivial as going to Etherscan and looking at like the TVL. Like, are there actually assets in this contract? What does this contract actually do? Is there like some backdoor function where like the admin can basically withdraw all user funds, or does it use some sort of other permission system for to hold all user assets? So yeah, I think that's something that centralized exchanges cannot offer. I mean, they can do these audits and so on, but I mean, there are a lot of issues with that. With some exchanges may lie about that, fabricate it, use like some metaverse auditor or whatever to prove their assets. But I think like DEXs are sort of forced into proving solvency. And yeah, I mean, I think users also hold DEXs to that standard as well. Like if your contract's sort of not verified, people sort of point that out. People call you out for not, I don't know, being transparent. So I think obviously this thing is not like a 0 to 100 thing on day one. I think there's like a progressive way to open up your code, open up a bunch of stuff. But yeah, I think DEXs are sort of pushed towards the transparent side of the spectrum compared to centralized exchanges.
Yep.
Yeah, and maybe just to add on that, I think like at the end of the day, people are in crypto for a reason, and it feels very ironic to be trading these coins that are supposedly the governance tokens or the native tokens of these protocols that like change how we do things, remove these centralized actors, but we're trading these things on this like Web 2 technology stack. It feels very ironic, and the reason that it's happening is just that the UX and on liquidity, on ramps, everything that has been mentioned so far, it is really like why people are settling for this. But once all that stuff is figured out, like I don't think you need to ask like why DEXs. It's really like why would anyone trade on a centralized exchange? Yeah, so I'm very bullish on like everything being built here. I think like, in a couple years, these panels will be very different. Like, maybe the centralized exchange will be up here, and you'll be asking like why should you still be around? But
Yeah, I think like another really big signal that we can see is, I mean, almost every major centralized exchange has like their own blockchain, and a lot of those blockchains have DEXs. So some of these centralized exchanges, I'm sure they're aware that DEXs could be an existential risk to their business, and they are also trying to diversify away from their main business. So, I mean, we need to compete with those DEXs as well. But yeah, clearly it's not like they don't know DEXs do have advantages over centralized exchanges as well.
Yeah, I mean, on that point of transparency, let's dig a bit deeper on the tech side. So why did you choose the tech stack that you did, using an existing L1 or L2, or you're doing it, developing on your own chain, and what's the rationale behind it? For this one, maybe we can kick off with Jeff.
yeah, sure. We made a pretty interesting decision here. We initially wanted to build on Arbitrum, which I think a lot of DEXs do, and they make it work. But we found during our testnet phase that it was kind of hard to do specific things we wanted to, and we just we think it's like the path to least resistance in maybe 1 year or 2 years, but at some scale of growth. You kind of see that with UIDX. You kind of need to significantly re-engineer everything to be truly decentralized. And we basically made the decision to do that, pay off that tech debt earlier rather than later. So we built an L1 that is custom built for Hyperliquid, the Hyperliquid L1. So it's not general purpose. It doesn't support smart contracts. It really just runs the state machine that is the DEX. But because it's so custom built and optimized, it has the throughput. 20,000 transactions per second can easily be pushed by another factor of up to 10, I think, if push comes to shove. But it's enough to support the full order book, margining everything on chain. So it really makes MEV like much less of a concern, and also gets rid of the need for a centralized sequencer or off-chain matching. So it's a little bit annoying to us. We need to solve these sort of hairy infra problems while trying to push the product and get the adoption. But it's something we believe in strongly, like the right long-term solution.
So I think we're on the other side of the spectrum. We chose to build on Solana. We were one of the earliest DEXs there. And there was a point where we were also deciding, hey, should we build an L2? Should we build an L1 of our own? Or should we build on Solana? I think the reason that we went with building on an L1 that already existed was because it satisfied all the trade-offs that we were looking for, at least in the bootstrapping phase, while preserving the decentralization tendencies, because we're inheriting the security of the entire L1 versus building the validator network and all the heavy lifting of doing an L1. And we felt that that would be a sufficient trade-off for us. We have a fully on-chain order book that runs, I think, pretty much the only chain that is able to support it is Solana. As a result, we sort of do share block space with other DApps, but are still able to kind of churn out the performance that we want to see. That said, though, I think there's still a lot of resources that need to be shared, like RPCs, like block space, and I think Solana has done a good job at trying to ring fence that as much as possible to maximize the performance of every DApp, like looking at priority fees that helps traders on a single DApp prioritize their transactions over the others. So overall, I think the trade-offs made sense for us to build an L1 versus doing our own.
Yeah, I think for us, we also thought that we needed like an isolated environment for the exchange. I think the primary reason for that is because in times of like market volatility, that's when you want to trade the most. But I don't know, if Bitcoin just dumped by 10% in like 2 minutes, and like there's another NFT mint that's going on and sort of clogging up block space, that gets really, really annoying for traders. And I mean, we have seen this happened every month in the last 2 years. I think one of the recent examples was like we were also thinking of building on Arbitrum, but when the Arbitrum token launched, like the whole blockchain was congested for, I don't know, a few hours. All the block explorers were down. Users couldn't really make transactions. And I think it's sort of mission critical for the exchange to be up, even in any period of volatility. So yeah, we did realize we needed to build our own isolated environment. And the trade-off was like, do we build our own layer 1, layer 2, or something else? And I think like at that point in time, the tech for custom rollups was just getting sort of mature enough to use. So we were like the first OP stack chain where we just basically used the same code base as Optimism, changed a bunch of parameters, but basically we got like our own isolated environment, but still managed to inherit the security of Ethereum. So yeah, I think for us it was important to be Ethereum aligned. Over the last 2 years of our main product, all our users came from Ethereum, all our TVL came from Ethereum, and we just felt like we would prefer to stay Ethereum aligned. So yeah, building like a custom rollup using one of like the most mature tech stacks, which is like the OP stack, felt like the perfect set of trade-offs for us. But I mean, in a few years, things may change again. So I think we're not sort of married to this stack forever. I think it's what works best right now.
Yeah. Do I have time to add one more bit on that?
Sorry?
Can I add one more?
Of course,
I
yes.
think that's a really good point. I think with the congestion, like if a DEX, if your success of trading on a DEX is negatively correlated with how prices are moving, that seems like a pretty bad user experience. So I think the congestion is a really big deal. I think one thing for us that the custom L1 really works well with is that you can bake in some perp exchange specific functionality like into the L1 itself. So like this is really good for guaranteeing like platform solvency in like really extreme scenarios. So like if you, for example, need to like do some liquidation system or deleveraging, you can have that happen like at the validator level, not at the like user triggered transaction level. Funding is another good example that's less edge casey. So like if you can trigger some stuff within the consensus itself, it actually makes these sort of like otherwise annoying batch operations a lot more trivial. So it's like the hard work shifts from working around the EOA-based system of an L2 or general purpose L1 to like designing the more like infrastructure level, but then some of these other problems actually become easier.
Sorry, can I touch on this?
Of course, yeah, feel free.
I think I think that's an important point, but I also think that inheriting the same like block space as funds that are already on the L1 helps reduce the likelihood of it just being another centralized exchange. Because at the end of the day, I think L2 and L1 operations do rely on a centralized sequencer and new validator operations. And that can be somewhat of a segmented experience from the rest of the crypto like DeFi space. So composability, I think it's one point there that we haven't really touched on. That is a benefit of like being on a shared space. But yeah, I think it's...
Yeah, I think like the main drawback of isolated environments is we give up composability, like composability with apps that are sort of near your ecosystem. So for example, it's like you break composability with Uniswap if you don't build on layer 1, or if you're on Arbitrum, you sort of can plug into all these different apps, but we sort of give that up in exchange for like isolated environments. I'm pretty sure in like the future, most of these layer 1s that are sort of built specifically for exchanges will also have multiple apps built on it. Like Say is trying to do that. So I'm pretty sure there'll be like along the spectrum of fully composable or single app that's sort of like a middle ground as well, where there are multiple apps that fit similar profiles, that fit trading. That's also tailored for the layer 1.
Yeah, I think for composability part for DEXs, that's definitely something that we're very good at. So let's switch the gear a little bit and talk back to the liquidity issue. So realize that Hyperliquid, Drift, and now Circuit have all launched market-making vaults. So wonder if you can share a bit of background of what's the origin story behind that, and why is that important for DEXs?
Yeah, for us, it was a bit of basically our background is in crypto HFT, like market making. And so after the FTX collapse and the whole Alameda debacle, we were about to launch mainnet. So we really wanted to make sure to distance ourselves from that. And then it turned out to be like a cool experiment because it really let us engage the community and really create this like protocol-owned liquidity while not having it be dumb liquidity. So like there have been a lot of studies on, like if you just put funds in this passive pool that gets arbed, then you're just losing money on every trade, and that's not sustainable for a protocol. But HLP is this like middle ground where it takes the Uniswap model where I guess instead of spot assets, it's just USDC collateral, but that is provided by just the decentralized community, and then the algorithm itself runs more like an active strategy that a market maker would make. Yeah, and it's worked pretty well. Like, it's been an experiment the whole time. It's really like a bootstrapping thing. Like we want to leave room for other market makers to come in and do the legs of the trade that maybe HLP cannot do. Like as a fully on-chain strategy that's isolated to the Hyperliquid L1, it cannot hedge on a centralized exchange, but another market maker can come in, take HLP's position, and collect the funding rate spread between Hyperliquid and a centralized exchange. So it really is meant to be like a building block in this ultimately this like ecosystem of market actors, much like you see on all the other exchanges. So yeah, that was the thought behind it.
For us, we launched Drift Liquidity Provider about 2 months ago. We hit around 7 mil of liquidity since then. And the motivation behind launching DLP, sort of like looking at GLP success initially and thinking about doing and replicating this in a smart contract level on an order book. I think what we were interested in to explore was what if we could build a primitive for users providing liquidity on an order book. And when I say this is fully on-chain, the strategy is actually happening on the AMM level, where the AMM decides how wide the spread should be in the order book and then also skews certain way depending on the inventory. So similar to a market maker, it has some intelligence baked into it, unlike a regular UniVT pool that doesn't rebalance. And I think the experiments like HLP and DLP and even Circuit I'll be interested to hear about is can users as easily provide liquidity to an order book as they did to a UniV2 pool? And I think that's the kind of primitive we need for retail provided liquidity to actually happen within perps. And I think once we crack that, then similar to what happened with UniV2 AMMs, then the retail flow will like really flood in. So yeah, I'm really excited and very bullish on these innovations.
Yeah, so for Circuit, we pretty much share the same ideology behind that, is that we're trying out the vault model and see whether we could be doing what Uniswap V2 is doing for the spot market, for the AMM market model, and then we're doing it for the order book model. And we just launched our first partnership with Drift as well. So really excited for that. So as we're approaching to the end of the session, we have one last question for all the speakers here, which is something that probably everyone's most excited about. So what are you working on right now, and any exciting product launch to share for each of you? Anyone wants to kick off first?
Yeah, I can start. I think basically we started this project called Ribbon Finance like 2 years ago, and the core idea was like a lot of users were they didn't really understand options much, and sort of the yields in DeFi were pretty low. And I think we saw these like brokers in Asia sell these structured products to like Bitcoin miners, Ethereum miners, and other crypto whales. And we were trying to think like, can we replicate those types of products on chain? So we've been doing that for 2 years. I think some of the major issues with that was these products are not sort of evergreen. They work in different market regimes. Sometimes they do really well, sometimes they do really badly. But I think a lot of DeFi users want something that's simpler, and they don't need to think about what kind of market regime am I in. Like, do I want to sell vol when vol's low? They don't really care. They just want to earn yield. So I think we are working on what we call Evo strategies, which is basically like V2 version of what we did at Ribbon, and we're trying to add some intelligence to execution, some intelligence to when these products sell options, when they buy options, when they do different types of things, instead of it being like a dumb strategy that just does one thing all the time. So yeah, I think we are looking forward to building these strategies, and some of it will be protocol, will come from the protocol. Some of it we're trying to partner with other people. And yeah, I think basically we're trying to cater to the DeFi users who are looking for some sort of sustainable yield product that they kind of understand the risk profile, but it's also safe for them to use. So that's the major thing we're working on, other than growing our options and perps order book as well.
When is that going to be able for the public to use?
That's going live in Q4.
That's really cool. What about you, Jeff? Any new product launch or any new perps that people can trade on?
Yeah, always thinking about new perps that are interesting. It's cool. It's like a unique opportunity as a DEX to really embrace the spirit of crypto and try to list these things that centralized exchanges are incapable of doing. So that's always on top of our mind. Maybe like what we're most excited about in the coming quarters is like thinking about how to like align incentives within the ecosystem. We've been kind of putting this off for a while. Like you'll see HLP has made like almost $1 million for the depositors and more than 7 million TVL. It's really been growing like exponentially, but the value capture, so like the important thing is to have the value go to the protocol, but it's very unoptimized, right? Like right now it's like very capital inefficient. There's like way too much capital for what is needed for the market making. And so like thinking about how depositors, traders, market makers can all come together and really like begin to decentralize this protocol is like the big project ahead of us. Yeah.
It's cool. What about you, Cindy? Anything on Drift?
Yeah, a bunch of stuff that we've been cracking up. So I think 3 things at the top of mind. One is we're building a MetaMask snap that's actually launching today that allows any users with a MetaMask wallet to connect to Drift via snaps. And we're the only Solana protocol that enables this right now. So that opens up, I think, the Ethereum alignment and the area that we're starting to go into as well, to really truly be a chain agnostic DEX. Secondly, we're also launching a couple of incentive programs coming up that are more unique and has a unique spin to it. So I think one thing we're excited about is this idea of giving a sweepstakes lottery style to users where they can trade and use their trading volume to actually win a share of the protocol profits. So I think that's like some interesting experiments that we're looking at. And third, obviously, I think larger programs to attract more like community market makers, traders as well, and really focusing on how we can align the interests of the people in the protocol as well. I think we have like keepers who maintain the order book, we have traders, market makers, liquidity providers. So there's just a lot of entities right now that are involved in the protocol, and like Jeff as well, I think we're interested in unifying all of those and making sure their interests are aligned with that of the protocol.
Yeah, totally. And for Circuit side, we are also very honored to launching our first vault together with Drift protocol. So all the whitelist user can now test out the vault and deposit into the vault to be a liquidity provider for Drift's order book. So it's really exciting what we're building together. And I'm sure in the future we'll see more involvement in a DEX space. And one day, I'm sure that there's more innovation coming from us that centralized exchange want to learn from. Yep. So thank you so much for everyone's time coming to today's panel. And lastly, how do the audience get in touch with you? What's the best way? Twitter, Telegram, yeah.
Yeah, Twitter is the best way. We're at Drift Protocol, or myself, Cindy Leow, TT. Yeah, we'd love to chat.
Yeah, Twitter's good. I think for us, the best is Discord. We like to talk to users. Pretty active. It's not all serious stuff, shoot the shit with us. But yeah, it's a growing community. We would love to have you hop in and say hi and ask any questions.
For us, it's Twitter, AvoXYZ at Twitter, or my personal Twitter, which is at Julian Co. Yeah, we just try to respond to most DMs. So feel free to just send us a message or something.
Sounds great. I'm sure all the speakers will be around, so if you have any questions, feel free to reach out to them individually. And thank you, everyone, for joining us today. My name is Sue, and thank you for all the speakers as well. Yeah, thank you. See you again next time.